Hi, in this video we are going to have a look at the cost of equity. It is the one of the component of cost of capital. What is cost of equity? It is a return that a company must realize in exchange for a given investment or a project. When a company decides whether it takes on a new financing, for instance, the cost of equity determines the return that the company must achieve to warrant the new initiative. The CAPM formula can be used to calculate the cost of equity, where the formula used is cost of equity is equal to risk-free return or risk-free rate of return plus beta into market premium, that is risk premium. This is the formula used in the calculation of cost of equity. We'll break down one by one all the components which are there in cost of equity. First one, risk-free rate of return. Now, the risk-free rate of return is nothing but it is the interest rate an investor can expect to earn on an investment that carries zero risk. Simply, we can say risk-free rate of return is nothing but return without any risk or return with zero risk. That is what we call the risk-free rate. It is a theoretical number since technically all investment carry some form of risk. As explained, nonetheless it is common practice to refer to the T-note rate as a risk-free rate, while it is possible for a highly rated government to default on its securities. The probability of this happening is considered very low. The security with risk-free rate may differ from investor to investor. The general rule of thumb is to consider the most stable government body offering T-notes in a certain currency. For example, US T-note rate, whereas an investor investing in securities traded in euros or France should use the equivalent Swiss or German note. Take for example in India, zero coupon bond, which carries zero coupon, that is zero interest rate. So 5 years bond or 10 years or 30 years zero coupon bond is there, which is considered as a risk-free rate of return. Now let's see in detail, how does the risk-free rate affect the cost of capital? The risk-free rate is used in the calculation of the cost of equity, which influences a business weighted average cost of capital. A rise in risk-free return will pressure the market risk premium to increase. This is because as investors are able to get a higher risk-free return, riskier asset will need to perform better than before in order to meet investors' new standards for required returns. In other words, investors will perceive other securities as relatively higher risk compared to the risk-free rate. Thus, they will demand a higher rate of return to compensate them for the higher risk. This slide depicts the cost of equity formula. Cost of equity is equal to RF, that is risk-free rate of return, plus beta. Beta means risk. We can define the beta in one word, that is called risk, which is used to measure the volatility of return of a stock. Then beta multiplied with risk premium, that is RM minus RF, market return minus risk-free rate of return. It's nothing but return over and above the risk-free rate, that is called risk premium. So this already we have seen. In a nutshell, risk-free asset on a risk-free asset, the actual return is equal to the expected return. Therefore, there is no variance around the expected return. That means zero risk. For an investment to be risk-free, then it has to have a no default risk, no reinvestment risk. Default risk means fail to make the payment of debt. So it must carry no reinvestment risk also. So what kind of risk-free asset is there which is carry no default risk and no reinvestment risk? Zero coupon bond. The risk-free rate is commonly considered to be equal to the interest paid on a 10-year highly rated government treasury note. Generally the safest investment an investor can make. Now, what is a reinvestment risk? Reinvestment risk refers to the probability that an investor will not be able to reinvest cash flows such as coupon payment. So, for zero coupon bond, there will be no coupon payment at a rate equal to their current return. Zero coupon bonds are the only fixed income securities that has no investment risk, as no coupon payment. Coupon payment in the sense rate of interest. Okay. Risk-free rate in US dollars. In valuation, we estimate cash flows for our or at least for very long time periods. The right risk-free rate to use in valuing a company in US dollars will be a 3-month treasury bill rate, 10-year treasury bond rate, a 30-year treasury bond rate, a TIPS, that is inflation index treasury rate. Risk-free this slides depicts the risk-free rate in euros and risk-free rate in Indian rupees. The Indian government had 10-year rupee bonds outstanding with yield to maturity of about 8.5% on January 1, 2012. This is data of year 2012. So the Indian government had a local currency sovereign rating of BAA3. This is a rating. So local currency sovereign rating. Based on this, the risk is measured. The typical default spread over for a BAA3 rated country bonds in early 2012 was 2%. The risk-free rate in Indian rupees, the YTM, yield to maturity on the 10-year bond, that was 8.5% on the time. Then we have to add the default spread with the risk-free rate of return to arrive at real rate of risk-free, a real risk-free rate. Thank you.